Boom shakalaka, what is up guys? Randall here with Andrew and Charlie from the Crypto CPAs. We have some crypto tax experts in the house. Alright, what's up everybody? Welcome. We're going to give it a minute or two for everyone to roll in, everybody to start watching this. But real fast, just give me a 1, let me know that you can hear me. And then we will get started. Alright, let's see. Cool. All right, we can be heard. So hello, Andrew. Hello, Charlie. What's going on, guys?
Hey, everyone. Thank you, Randall, for having us on the show.
Yeah.
Hello, everyone. Thanks for having us.
It's a pleasure to have you both. Thank you so much for joining us, especially when there's football on. My bad. I did not realize that earlier. Right?
But one good game in us, at least.
Yeah, absolutely. So we will try and make this as impactful as possible. Give you as much information as possible in this short period of time, and then that way you guys can go and watch football if you want to do that. All right? So cool. So we'll get started now. Everyone can hear us. A lot of people are strolling in. So I guess just to begin with, guys, what's going on with cryptocurrency and taxes?
Yeah, so in a nutshell, it's a lot of ambiguity. The IRS has kind of been slacking with releasing guidance. We're not sure why, if that's like strategy of theirs to be very kind of clandestine about it. It's frustrating a lot of accountants. So right now, I guess the go-to for most CPAs is do everything according to the limited guidance that's out there and be extra safe doing it. We don't like to fearmonger, but we do know the IRS is in possession of lots of names through Coinbase and possibly other exchanges, and they've contracted groups that are better than they are to really track down these blockchain transactions. So, I mean, a lot of people were not concerned. They said the IRS has no idea of chasing this, and they were right. They don't. So they paid people who do know. Oh. And I know. So it's very important to play it safe, report things, and for the people who do try avoiding, maybe they get away with it. Great. Unfortunately, it could also come back to haunt them 3 years from now with the large penalties and interest as well. Yeah. So, the key is for now, at least from our standpoint as CPAs, is just really do the best you can to report all the income that you have. And that doesn't mean there's no strategy as far as tax savings, but definitely report everything and play it on the safe side.
All right.
I think just going off that a little bit, when you're looking up crypto-specific tax advice, it's likely that you will not find specific answers for what you're looking for. So as accountants, what we're doing is sort of using the existing framework and examples and government rulings of things that have happened in the past and trying to apply them to what is going on in cryptocurrency until there's further guidance.
Yeah, because that's interesting. I was going to ask you guys, where do you have to go to find this stuff? Because it seems like it's all brand new. They just kind of whip it all up out of nothing.
Right. So there are a few things that we do know. So for one, cryptocurrency is treated as property rather than a currency. And what that means is that the sale of it triggers, instead of a foreign currency gain or loss, it would trigger a capital gain or loss. So in that case, you have to be keeping track of your basis and your sell price whenever you're trading cryptocurrencies and even in between coins.
Yeah, what that means, it's not only, a lot of people have this misconception that you only have to worry about it when you switch back to fiat. We're under the understanding, and most CPAs will tell you as well, even coins for coins exchanging is a capital transaction. So even if you take Bitcoin and use it on Bittrex or Binance and get Neo or some other altcoin, it's just like selling the Bitcoin for cash and then buying that altcoin. And I know there's a lot of ambiguity with the new tax laws in 2018, where they basically said like-kind exchanges is limited to real estate transactions. That kind of got a lot of people hopeful, saying, oh, that means crypto to crypto is like-kind. Well, we don't really believe so. Most CPAs will tell you the same thing. Crypto to crypto is not a like-kind exchange, and it's very important to keep track of even crypto to crypto trades as capital transactions.
Mm-hmm.
And once again, it's not like foreign currency accounting. It's not like buying euros with US dollars. It's not recognized a currency at this stage. Um, so yeah, everything for the most part is a capital gain or loss when it comes to trading.
Wow. So what does that mean for us in terms of reporting? Like we have to actually write down every single trade we have and the value they're worth. Really?
Um, yes, really. There's one way we can touch on later about how to avoid that.
Okay.
Um, but the good news is there's tools out there, whether you're pretty familiar with Microsoft Excel or Google Sheets, and you can kind of come up with something yourself based on timestamps and historical prices, or there's pretty good software out there, including Bitcoin.tax,
Okay.
CoinTracking.info. The cost will depend on the amount of volume you're doing, the amount of trades you have. I believe coin tracking is free under a couple hundred trades, as well as Bitcoin.tax.
Mm-hmm.
But for actual traders, people with some volume, you can look to pay for some of these tax softwares, which are, I mean, they're a saving grace, really, because yeah, as you said, I mean,
Yeah.
people making 15, 20 plus trades a day, it gets very, very hard to track.
Yeah. And do you happen to notice that tax software integrate with the exchange so it records it for them?
They do have an API feature, and with those API features, you do have to be careful with only allowing view access if you're not familiar with API. Now, they all do not have this option. Some of them you have to export CSV files, but for the most part, there are pretty seamless integrations with some of the exchanges.
Okay.
With some of the lesser known exchanges, you will have to export a CSV file, and you might have to do a little bit of manual manipulation of the file to make the software accept it.
Mm-hmm. All right. So a question that's related to what we were just talking about. So
Okay.
is the coin-to-coin taxable event only from 2018 on, or does this apply to 2017 as well?
Our position is it applies for 2017 as well, additional, and 2016, 2015.
Wow.
All prior years, we do not believe crypto to crypto is considered a like-kind exchange.
Okay. Yeah. And so basically for everyone watching, that means that, yeah, all of your trades over the past year or more. Wow.
We do want to reiterate that it is possible to make a like-kind election. However, it is not clear that the IRS will accept it, and that like-kind election is considered an aggressive stance by many accountants. And the consensus is that these are not like-kind exchanges. However, depending on your risk tolerance, you could take a like-kind election.
Okay. Gotcha. Yeah, so that seems to be a lot of stuff coming up for taxes. Now, you guys have a lot of people reaching out to you about taking care of their taxes in cryptocurrencies?
Yeah, absolutely.
Yeah.
Yeah, I mean,
Yeah.
we're getting several calls a day and taking on many new clients. I mean, we have other clients who tell us, "Oh, what do you mean it's not a like-kind exchange? Like I'm going somewhere else," and that's
Yeah.
fine. I mean, we're interested in helping the people who want to do things by the book and report their income, and even doing things by the book is difficult, really,
Yeah.
in this space.
Yeah, because it seems like your stance in taking the like-kind exchange thing is just to protect your clients. You want them to be as safe as possible to do that type of thing.
Exactly, and once again, we're not in the business of fear mongering. Like we're both personally traders ourselves, and we both have, I mean, at least by our standard, sizable short-term transactions, which unfortunately, yeah, we're going to be paying a tax bill on them.
Yeah. So I guess for everyone watching now, I guess just tell us a little bit about yourselves, where you came from, how you got into the crypto tax sphere.
Sure. Charlie, do you want to start?
Yeah, I'll go ahead. So my name is Charlie. I'm from Milwaukee, Wisconsin. I went to the University of Wisconsin. For the past few years, I've been living abroad between Rio de Janeiro and Medellin, Colombia, working for an international tax accounting firm. And sort of over the past couple of years, this passion of crypto has just sort of crept into my life to the point where I'm trading on a day-to-day basis, and also just reading and staying up to date, much like all of you. And what we've realized over really the past year is that there are a lot of cryptocurrency nuances that are not applicable to other areas, and that there's a lot of bad information about cryptocurrency out there. So me and Andrew, being traders ourselves, we decided to sort of tackle this niche market, since we are both CPAs and we know just sort of all the right questions to ask in cryptocurrency tax accounting. And so we started the company about a few months ago, and now we're sort of building our client portfolio day by day.
Mm-hmm. Cool.
Yeah, and I'm from Miami, Florida. Went to University of Florida Atlantic University, just about an hour north of Miami. And I've been in tax for about 5 years, always either working for a bigger firm or doing it kind of as like a side business for myself while I was the controller of a pretty large medical center down here in Boca Raton. About 2 years ago, I went through this quarter-life crisis of sorts, quit my job, rented out the house, sold my car, and
Nice.
went off traveling through Europe and Asia. And especially in Southeast Asia, I got to see kind of like how screwy the global financial system can be, and like how difficult it is to deal with money, including South America, where I ended up meeting Charlie. It's I mean, if you think you have it bad here at the bank, I mean, try going to one of the banks in Rio de Janeiro or in Medellin, Colombia. You're in line for like 45 minutes, and it's terrible. It really is terrible. It's a mission to move money in some of these places.
Wow.
And it really piqued my interest in Bitcoin, and I ended up buying my first Bitcoin towards the end of 2016, and it's discovered alts a few months later, and it got to the point where, I mean, it was the one thing that excited me was trading these altcoins. And I was still working at the same accounting firm as Charlie at this time, the international accounting firm specializing a lot in expats and U.S. citizens who end up moving abroad, which actually does go hand in hand with cryptocurrency, which we can touch upon later. And Charlie and I both branched off, left the company, and formed this because we're very passionate about it, and we realized there is a lack of information and an opportunity to target a lot of underserved people.
Yeah, definitely. So that I was just thinking while you were talking. So since now we are taxed on every single, or since we've always been taxed on every single trade, but now we know more about that. Does that change the way that you guys trade?
In one way, it can, and I guess we could talk about this now. It's for people with retirement assets. It's the really surefire strategy to avoid this is rolling over one way or another your retirement assets to either a self-directed Roth IRA or a self-directed 401k. And basically, when your retirement asset is in the form of a Roth, it can grow tax-free. Mm-hmm. So you don't really need to worry about keeping track of any trades or reporting. So it grows tax-free, and then when you pull out your money, when you distribute it, it's tax-free. Caveat, you have to wait till you're 59 and a half to pull it out without getting penalized. So
so cryptocurrencies have to exist until we're 59 and a half?
Not necessarily. I mean, a penalty will be 10%, and then your tax rate on the earnings that you end up pulling out will be at your marginal tax rate. So say you hit it big, your alt portfolio went up from 100K to 10 million. You want to go live on an island somewhere. You don't need all that $10 million at once. Mm-hmm. So if you were trading the way you are now, just on Bittrex, on Binance, you're just racking up short-term capital gains, $10 million, you're likely going to pay 40% of that, depending on what state you're in, maybe a little more. Mm-hmm. If you do it through a Roth IRA and you want to pull out of it early before you're 59 and a half, you will pay that 10%, but it'll be at your marginal tax rate. So if you only pull out $50,000 a year, for example, you're going to pay taxes only on $50,000 at that year, which obviously, when you earn $50,000 in a year, it's taxed lower than if you were to make $10 million in a year, because we have that progressive tax system. And short-term capital gains at your marginal tax rate, if you made several hundreds of thousands of dollars, it gets to that 39.6% tax bracket.
Okay.
So you can kind of control it, and there is some tax benefits, and of course the nuances of reporting get tossed out the window.
All right, gotcha. So another question here. Through someone's asking specifically about your tax services. So they say, through your service, do you guys do taxes fully? And they say, I imagine W-2 included, or just the crypto side, because they're from Tampa, and do you do any locations or just Miami?
Sure, we have sorry, Charlie and I are kind of deciding who takes these questions, but I'll take this one. I'll give him the next one. Yeah, we are full service. We do file your entire tax return. We have a couple different price levels. Typically, they're based on your trading volume.
Mm-hmm.
That being said, we know each tax situation is really unique a lot of times. So if we can give a quote based on transactions, and then if you end up having like 20 different jobs, 15 rental properties, and 6 foreign corporations, it's very hard to quote. But yes, we do file full tax returns. W-2s, 1099s are no problem. It's really, quotes are going to be based on individual basis. Typically our tax returns run from $500 to $1,000, $1,000 being for active traders with 2,000 plus trades per year, and that's kind of assuming like you're a basic tax situation outside of trading. Like you have a W-2, maybe you have some student loan interest, maybe you own a house, but just without any kind of wild tax situations, any side businesses. The upper range of our services run about $1,000 for a full service tax filing.
We are a virtual firm, so our clients are based all over, and being based in Tampa would be no issue. We have clients all over the world, in fact. Everything is done online. We collect the documents online, and we can ultimately e-file once we get an e-signature online. So there's no need to be meeting in person for most of our engagements.
Perfect. So yeah, I guess I'll just answer some questions now. That way we can do that and then come back. Someone asked, they have a few questions. One, if they do thousands of trades, should we pay taxes on the gains at the end of the year? I guess as opposing to each individual trade. And then I guess we can answer that first.
Sure.
I think it's your turn, Charlie.
Okay, so with cryptocurrency trading, unlike a W-2, you're not having tax withheld throughout the year. And now the IRS requires estimated tax payments throughout the year if you do not meet these safe harbor thresholds, which I believe is 90% of your tax due. And so if you don't have that entire amount withheld, you will end up owing an underpayment penalty. And so the short answer is, if you can reasonably estimate your gains, you should be paying a tax throughout the year. Now with cryptocurrency trading, it's so volatile, and you might have a very high gain that you were not anticipating. In that case, you will end up paying more towards the end of the year. But if possible, and you reasonably expect to be making 200, 300%, you should be paying quarterly estimated tax payments.
Okay, awesome.
Can I just interject really quick before that next question? I just want to stress the importance of kind of knowing where you're at with these capital gains, and especially as you near December 31st. I mean, as I'm sure everyone's refreshing their Blockfolio and checking CoinMarketCap here and there and seeing like these red 20% here and there. As of 12/31, if you were up, we'll say $200,000 for example, your tax liability is locked in, and it's very important because as of that moment, doesn't matter what you do. January 1st, your portfolio might go down 90%. Your tax liability is there. So if you owe $60,000, I mean, just keep in mind that if you don't set aside that money for taxes, you're basically borrowing money from the IRS in a way that's not very different from maxing out a credit card to gamble on cryptocurrency. Wow. So I mean, I love seeing the green. I love it when the market goes up, but it's very important to kind of know that it resets, and you can lose everything in February of 2018, and that doesn't wipe out your tax liability from 2017. So it's very important, whether on your own or with an accountant, to kind of keep track of where you are in the year with your gains, so you don't get locked up there, or you're not completely illiquid and scrambling to find cash somewhere to pay a tax liability. And yeah, with that, go ahead with the next question.
Well, with that, when I was doing my amateur online research about taxes, there was something that looked like you're held fully accountable for your gains, but your losses you can only claim like $3,000 per year, and then that carries on. Is that true?
To an extent, you can deduct your losses to the extent of which you have gains. So if you had I don't know, you sold conventional stocks and bonds and you made 100,000, and then you ended up losing $90,000 in crypto trades, it would net to a $10,000 gain.
Okay.
Now, using the same numbers, except say now you lost $120,000 in cryptocurrency trades, there's an extra $20,000 in losses above your gains. You can deduct a maximum $3,000 per year until it's all used. But so long as you have gains, you can deduct the losses against those gains.
Got it. That makes sense. All right. So the second part of that question was, if we kept our fund in 10 different wallets or exchanges, including one without our personal details, should we report those funds in an exchanges? For any lawyers out there, the answer is, of course, yes.
I mean, once again, we're CPAs. We have to tell you report everything.
Yep.
I mean, that's all there is to it. If you earn money, you made money by tax law, you have a gain, you have to pay taxes on it. We can't tell you anything else as CPAs.
Yeah. Well, this is actually a good question, because I mean, tax evasion, avoiding taxes, those are both punishable offenses. But like, what type of punishments can people look forward to with that stuff?
Well, the difference between tax evasion and tax avoidance. Tax evasion is illegal, can result in fines, penalties, depending on how much, jail time. Tax avoidance is using strategies to legally avoid paying higher taxes. So avoidance is okay, evasion, stay away from it.
Gotcha.
We honestly don't even want to speculate on the penalties, because we don't want to encourage it. We don't want people to balance risk and reward and do any kind of crazy.
But it's nasty stuff. It's fines, it's prison time, and we all know what happens in prison. So yeah.
I don't actually.
I've seen a few TV shows. It doesn't look fun.
Yeah. I mean, the problem is, even if it's just $10,000-$20,000, nothing you go to jail over. But if they come back at you in 2019 and say, hey, we uncovered this, where was this? It's just the retroactive interest and penalties you get hit with, it can really be damaging. And you don't want it hanging over you. It's better to be in compliance as far as we're concerned.
Yeah.
So, having money in a wallet, having coins in a wallet rather, it's not illegal in and of itself. As of now, there's no rule to report it. Like, I'm not sure if any of the listeners are familiar with FATCA laws and having to report foreign bank accounts when you have more than 10,000 USDs of assets in foreign bank accounts. As of now, we believe crypto does not fall under that category, so there's no need to report your. When you have more than 10,000 of crypto on foreign exchanges, we don't believe you have to report that. And that's the one benefit. So if you have $1 million in a wallet, there's really nothing you have to worry about unless you are selling that crypto and making gains with it.
Gotcha. Cool. So, do you recommend amending returns if you've reported your gains and losses incorrectly in the past? Is the IRS going to target individuals who put Bitcoin in their Schedule D, or just big players?
I mean, Bitcoin should go in your Schedule D.
Okay, good.
Yeah, Bitcoin. I mean, sales of Bitcoin is capital gains and losses unless you were providing some kind of service in exchange for that Bitcoin, in which it would be on your Schedule C typically. Okay.
I think this may potentially be in reference to how we were talking about how each coin that you trade, you need to report that stuff. Potentially, if they didn't do that previously, would you recommend them amending their previous tax returns to include that?
Right. So it'll depend on a case-by-case basis. The short answer, the by-the-book answer would be yes, amend it to make it correct so it's an agreement with this stance that coin-to-coin trading is a taxable event. Now, it will depend on the numbers. If they're negligible amounts, then you can just sort of correct it going forward. But the correct answer would be to amend back as far as you can, and then just do it correct going forward as well.
Okay, gotcha. Hey guys, so someone just mentioned that the audio is coming through funny. So guys, give me a 1 if you can hear this well. Give me a 2 if it's not coming through very well. Alright. 1, 1. Okay, cool. So most people it's coming through. Guys, if you're having an issue with the audio on here, sometimes just try reloading the page on YouTube. Sometimes that can do it. There can be some stuff. Also, this is going to be available afterwards, so if you want to refresh it, you'll be able to hear it again. All right, cool. So let's see. Here's another question. Would a trader be taxed the same if they were trying to gain Bitcoin or USD? If Bitcoin were accepted as a currency, what would they be taking their profits in? Let me ask that again because I didn't understand that question, so I'm not sure if you guys will. Would a trader be taxed the same? Would a trader be taxed the same as if they were trying to accept Bitcoin or US dollars? If Bitcoin were accepted as a currency, would be? I don't understand the question. We'll have to go on to the next one. Can
sure.
you?
I can try answering that in 2 ways.
Sure.
I mean, the first way is if a service was done in exchange for that Bitcoin, or something was offered in exchange for that Bitcoin, you basically, whether it's Bitcoin or anything else, you take the fair market value of that property, and that's considered income. Mm-hmm. If the question is if Bitcoin were to be classified as a currency by the IRS, like if Bitcoin was, say, the euro or the I don't know, the Colombian peso or the Mexican peso, then yeah, it would be different. It would be a different type of taxable event. Mm-hmm. But as of now, it is property, and if you receive it in exchange for something, it's going to be at fair market value of Bitcoin is in USDs.
Okay, gotcha. So someone asked, what if they get hacked and all their Bitcoins are stolen? Do they still have to pay taxes?
I think I see where that question's going.
Yeah, I know. I think every American Bitcoin investor is suddenly hacked. Yeah, but mm-hmm. I mean, what would happen with that? They would just have to claim it as a loss if that actually did happen.
Right. I mean, whatever they bought the Bitcoin for, it would just be no gain on the sale. And additionally, if it was purchased, say you purchased $50,000 worth of Bitcoin on Coinbase, transferred it to your ledger, and your ledger was hacked, or mm-hmm. I don't know, however people are losing their money these days. Mm-hmm. Yeah, there's special write-off rules where you can actually take some of that loss as against some of your other income as well. Mm-hmm.
Yeah, but you mentioned previously that the IRS is actually hiring like cyber people who are actually able to track stuff and figure out all this stuff, so they can find out where all the money's going, what's really happening with it, and kind of have an idea.
Yeah, I can give you the name of the firm they hired. I recently shared an article about this on our Facebook page. Speaking of which, anyone wants to show us some Facebook love, we do love likes.
Yeah, guys, if you down in the description, there's their website and also their Facebook page. If you're enjoying this, go there, click on the like, show them some love. Yeah.
Thank you. Mm-hmm. So the name of the firm. Sorry, 3 more seconds.
Sure. The previous question, while you're doing,
it's called Chain Analysis. Chainalysis is the firm that they contracted.
Chainalysis, so like a mix of chain and analysis. Chainalysis, cool. Mm-hmm. Awesome. All right, so that previous question that I did not understand. Basically, he wants to know if he accumulated Bitcoin, is it taxed any differently than if he cashed out into US dollars? So like if he's just buying and holding Bitcoin as opposed to just buying and holding US dollars, cashing out.
If he's buying and holding and he is not sold into a different cryptocurrency or cashed out to US dollar, there would be no taxable event yet. Now, the moment he trades out of that, there would be a taxable event, whether it be to fiat or to crypto. Did I understand that question correctly?
Yeah. Yeah,
Okay.
I think that's good. So someone asks, can you walk us through how to set up the Roth IRA for cryptos?
The answer is no. We're not IRA experts. We do have a contact that we are happy to introduce you to. Typically, I believe he charges between $1,000 and $2,000 for the setup of this account. There might be some cheaper guys out there. If you'd like us to introduce you to our guy, he's very professional, very quick. Please reach out to us. It's at the end of the video, and we're happy to make an introduction for you.
Okay. Is there a way that you prefer they reach out to you?
Email would be best. Contact at cryptocpas.com, and also, as you were going to mention, we are still offering complimentary 15-minute sessions to see if it's a good fit, and it'll be a limited time as we get busier and busier as we approach this April 15th deadline. So can't guarantee that's going to be around forever, but for at least the next couple of weeks, we're happy to talk to you over the phone as well, and our contact info is on our website. So feel free to reach out to us.
Awesome, guys. So if you have any specific questions, that we're going to try and answer everything here on this webinar, but if there are specific questions that need to be answered specifically, if you want that information, contact at cryptocpas.com. And just because they like you guys because you watch Crypto Love, they're going to hook you up with a 15-minute consultation, but the sooner the better because they are filling up, and it's tax season. Yeah. Cool.
Correct.
So let's see. What about, let's see. So someone asked, what about cloud mining? They've been mining some stuff. Do you know about the mining and rules on that?
Yeah, mining is basically ordinary income. It's different from capital gains income. Unfortunately, it's a little more unfavorable. Cloud mining, I believe that's when you invest in one of these companies and they do all the work for you. It's like their computers doing it. They just pay you a dividend. Yeah, so it's just ordinary income. Dividend income. There's really nothing to write it off with. That being said, if one of these cloud mining companies ends up being a Ponzi scheme or one of these I don't know, big connect like issues, and there are some capital loss ramifications to it. But yeah, as you get, whether it's whether you get some coins from mining or whether it's like proof of stake, as you get these coins, it's just ordinary income.
All right. Awesome. So someone asked, what are the different ways IRS retrieves taxpayers' trade information from an exchange? Or are they just asking the exchanges to provide all the trades?
We don't know. I mean, unfortunately, we're not IRS agents. I mean, we know they came after Coinbase. And we don't know which users, whether it was only the high valued ones or what. Yeah. Unfortunately, we haven't had any conversations with any agents yet. We don't really know what they're after. So once again,
just sort of going off of that, the fact that they got Coinbase's records from 2013 to 2015 only leads us to believe that it's a matter of time that they'll get their year-to-year records, and not only Coinbase, but these other exchanges, probably starting with the bigger ones, the bigger US ones, and then internationally we'll see what other countries do. Perhaps countries work together and provide sort of like a standard document. It remains to be seen at this point.
All right. Okay, so someone asks, can you discuss why the Bitcoin trading community is struggling with reporting their taxable gains, unlike the equity trading market, which seems pretty straightforward? I have an answer to this one.
Sure.
Because,
yeah, go for it.
Yeah, because all of us crypto people are like libertarians. We want money to be separate from the government, and the idea of having it taxed is just like, being stabbed in the heart. But that's just my point of view. What do you guys think?
That might be the case sometimes. I mean, other times, if you guys have like a TD Ameritrade account or any other equities account, they basically do it for you. You're not, for one, the volatility is nowhere near the amount, and so yeah, at the end of the year, the exchange is going to give you a 1099 with your trades, maybe not. It'll have anything you sold, it'll have that listed for you. because they all have computers that do this for you. As of now, with cryptocurrency, there's really no requirement for this yet, so the exchanges have not provided it for you. Yeah, it's really, if you think about trading conventional stocks and equities, it's never been on the user to track their own trades like it is now with cryptocurrency.
Do you think that's something that's going to change in the future?
It's possible. I think personally, I think there will be something where, at least for U.S. exchanges, they'll be required to provide some sort of report. We'll find out. It's very difficult. I mean, it's very easy for something like Coinbase, where you cash out fiat to USD, to issue a 1099 in the amount of which you cashed out crypto for. For something like Bittrex, where it's just like line after line after line of altcoin to altcoin trade, it's like, I don't think the IRS has any idea what to do with that yet. The company they contracted to look at transactions. I'm not sure if they have any idea what to do with it yet. So I think there's definitely discussions going on with regulatory bodies. I don't know when they'll come to fruition. As you guys know, we're currently shut down. I think like half at least as far as the IRS goes, I think half the agents aren't getting paid or not going to work or something. So we'll see how that pans out as far as people getting their refunds or people getting their tax returns processed. But yeah, something will happen eventually. It'll be slow, I believe, personally. But once again, I have no no way of knowing, and your guess is as good as mine.
All right. So someone has a company who's trading for them, and the trading is done by that company, similar to how a 401k might be invested or traded. When he goes to reclaim the funds, he'll have to produce evidence of all the trades, and will that be taxed in the same way you've been explaining? So it seems like he has a company who's doing the trading for him, so he's not trading individually, the company is trading them?
It sounds like this might be a cryptocurrency fund. If that's the case, where there's a number of investors in this fund, he should receive a K-1 if it's a U.S. entity that's doing it. Now, if it's if it's an international entity or company that's doing this for him, he would have to produce the trades that were applicable to his amount. Andrew?
It depends kind of what this is. Is this like an unofficial kind of fund, like just a friend trading for him on his behalf and just sending him some income, or it's really a little more.
Hey Alex, can you be a little bit more specific with that?
I believe what Charlie said is correct.
Okay. It isn't just it's a small LLC, single owner, just a friend, so.
Okay. In that case, the LLC should produce an entire return, in which case his capital that he put up, he'll receive a pro rata share of the fund's gain or losses, if it's done correctly.
Yeah, and then the problem with that is, as a single member LLC, it's just going to flow directly through to his friend's tax return. So it's really up to you and your friend to report that. I mean, as far as the IRS is concerned, it's him. He's going to file Schedule C on his tax return, and it's going to be up to you and your friend to kind of split up those capital gains, because as a flow through entity, one member LLCs, it'll come through in the method of which it was earned. So it separates between ordinary income and then capital gains income. And so I think the best way to do it would be to either separate it, like if you're paying him to manage this kind of, and then he kind of gives you a return. It really depends on how you guys want to do it. But just know the way it is now, as a one-person LLC, every single one of those capital gains are flowing through to his personal tax return, and then it'll be up to you guys to either make that a partnership and you get your share on a K-1, or him to just say, like, look, only half of these are mine, the other half are yours, and then you would put them on your return and have to list all the trades individually. I mean, the structure of that sounds like a disaster. If it's just his company, and It's an issue, and a lot of people are doing. A lot of people are collecting money from family and friends and just trading it on their personal accounts. I think the best way out of that is to make some kind of operating agreement between your funds and his funds, and what percentage of that is yours and what percentage of that is his, and to file as a partnership rather than as a one-person LLC going entirely on his return. Because in this case where these things are being tracked, are being audited, like it's all getting traced to him at this stage, and you're kind of invisible. So that's all I can really say about that. Sorry if that seemed a little jumbled, but if you have another question in regards to that I can clear it up, I'm happy to hear it.
Well, okay, so I'm sitting over here and all this stuff is going over my head. It seems super complicated. Is it possible for people to do taxes without accountants, or is it something where they actually need accountants to do this stuff?
It depends individually on your tax literacy. I mean, some people just naturally have a little bit of tax in them. Other people are going on TurboTax not knowing what to do and just royally messing up. Like we're not going to tell everyone they need an accountant. Some people who have a pretty good understanding of capital gains and losses can handle this themselves, and if it's a large amount of trades, they might be able to handle going on a cointracking.info or going on a bitcoin.tax. And if it's only big exchanges like Coinbase, GDAX, Bittrex, Binance, like it should have a pretty accurate report. Now, if someone's like only mildly tax literate and they have some of the smaller exchanges like Cryptopia, HitBTC, Gemini, just some of these exchanges that don't really produce a good report and aren't compatible with these softwares a lot of the time, it's a very wise idea to have an accountant to kind of know what to look for, as well as kind of strategize on what should be done before year end. The whole LLC thing, the whole one-man LLC thing, it's a common misconception at this stage. A lot of times people want to open up these businesses to deduct more expenses or whatnot, but as far as capital gains and losses go, they still are categorized as capital gains and losses. So even if you have them coming into an LLC or partnership or S corporation for that matter, they're still going to flow through to the eventual taxpayer as capital gains and losses. So at this stage, the benefit is just not really there.
All right, cool, thank you. So since you were just talking about coin tracking, someone says, do you think coin tracking has sufficient tools for reporting?
Charlie, want to go with that one?
So cointracking.info right now is the most robust software out there as far as tax reporting goes. So if you enter everything correctly and the API view access codes are pulling correctly, it should produce an accurate report. Now, a lot of times it might be a little off or it might be very off, depending on if you are including any shapeshift transactions that you made, trades that you made, which you will not have a history of. If you're doing it on, if you're just pulling CSV files off the exchanges, any forks that you do not have recorded in your CSV files, that all of a sudden you're trading, the software will get confused and it'll say basically, where is this coin coming from? So the software itself does its job. It's a matter of inputting everything correctly.
Awesome. All right, so someone asked, what's the different percentage of taxes, capital gains versus ordinary income?
Sure, I'll take that really quick. So this is a matter of just pulling up a quick tax bracket chart. You have two types of capital gains. You have short-term capital gains and you have long-term capital gains. Long-term referring to the holding period of the asset before you sell it, which are when you sell a long-term for a long-term capital gain, it's at a more favorable tax rate than a short-term capital gain, which a short-term capital gain is just taxed at whatever your tax bracket is. So a short-term capital gain, if you bought Bitcoin today, sell it a few days from now, or sell it or trade it for Ethereum a few days from now, that's a short-term capital gain. It'll be taxed at the same rate as, say, your W-2 wages would be. Long-term capital gain will depend on your total adjusted gross income for the year. So it's actually determined by your salary, by maybe other business income, rental income. But typically, the higher your adjusted gross income is, depends or will determine what your long-term capital gain percentage would be. If you're in the 10 or 15% tax bracket, as of 2017, you actually don't pay a long-term capital gain. So we had a couple clients who they just weren't working in 2017. They had a bunch of Bitcoin they were sitting on. They still believed in the project, and we said, look, you can cash out up to this amount of Bitcoin without paying a single dollar in tax. Like, we highly recommend it. And we told them, if you want to pay up to 10%, you can cash out up to this amount. So it's important to kind of determine and also plan. Like, if anyone wanted to go crazy like I did and just drop what you were doing and travel the world and not work, I mean, that's a great time to cash out some cheap Bitcoin at a more favorable tax rate. So yeah, it's I don't have them pulled up now. I don't think I can share my screen with this program, but
yeah.
Well, I guess I could. But yeah, it'll be determined based on long-term capital gains are determined based on your total adjusted gross income, as are short-term capital gains, but short-term capital gains are at your ordinary income rate.
All right, perfect. Someone says, suppose they earned $200,000 in profit last year and put it all into BitConnect and just lost everything.
Oh, I'm hoping this is just
I'm not sure if this is a theoretical one. Who knows? Yeah. But how much should they pay, and how do they explain this situation? Is this one of those lost things?
Unfortunately, I mean, I hate to answer it this way, but if you made $200K in 2017, it's income in 2017. It didn't turn into a bad investment until 2018, where it really unfolded, which you would write off a large capital loss, and the capital loss would be I guess you receive the BitConnect at $363 per coin, and then depending on when you got it to the exchange to sell it, would be your capital loss.
Yeah.
But it would be 2018 that you recognize that loss on the BitConnect.
All right. Next one is hodling a coin for 2 years and cashing out on the third year. Do you only pay when you cash out?
Yes.
Okay. Cool.
Right.
If 100% of someone's money is in crypto and they never cash out, do they still owe taxes? And where should they get the fiat to pay the taxes from?
I'm going to say no. However, if it's someone who's 100% of their worth is in crypto, there's a chance they're spending their crypto on goods. And it's something I don't think we touched on this call yet. It gets a little difficult to track, but using Bitcoins for purchases is also a capital transaction. If you bought Bitcoin back in the day when it was $100 and now it's, I think, around $11,000, and you use 0.0003 Bitcoin to buy a cup of coffee, that's just like, which I guess now you can't really do with these transaction times and these wait times, but it's basically just like selling 0.0003 Bitcoin for the value of that cup of coffee. So the answer is no. If you've just been hodling and not doing anything with it, there's no taxable event. But if you're making purchases with it, you do need to keep track of those purchases and the value of those purchases.
Or if they've been trading the crypto within that 100% of their portfolio, they would have a taxable event. And in that case, if they did have a gain to report, and they have to liquidate some of their portfolio to pay that tax, that would be an additional taxable event, potentially, depending on their trade history.
Okay.
I'm sorry, I may have misheard that question.
I think there were two ways to understand it. One if they just held Bitcoin, and one if they traded cryptos. So yeah.
Right.
Yeah,
I guess we answered it both ways. But basically, if they have it all in crypto and they're trading it constantly, they are likely, if it's going up, they're going to be incurring a capital gain. And in that case, if they have to liquidate some of their portfolio to pay it, that trade would be considered a taxable event as well when they liquidate.
But just to give an example on that, if you used, if your Bitcoin went up in value $100,000 and then you use that $100,000 of Bitcoin to buy lumens for $100,000, and say that lumens didn't do anything, it just stayed at a 100,000 USD dollar value, and then you wanted to liquidate, so you cash out those $100,000, there's no taxable event because you've already paid that 100,000 gain on the Bitcoin. Now, if those lumens went up to 200,000, there'd be an additional capital gain of $100,000, and if they went down to $50,000, there'd be a capital loss of $50,000.
Okay, gotcha. Let's see. So another question is just like, what do you mean by cashing out? Is it keeping U.S. dollars or Tether on exchange? Is it going back into a bank account? And when is the taxable event happening?
So the first taxable event would be a trade from a coin to a coin. And the second cash out I meant where there wouldn't be a taxable event. So say you use Bitcoin to buy Stellar, and the Stellar did not change in value, but you sold the Stellar to USD, whether OTC or whether there's an exchange that you can cash out any altcoin. That's what I mean by cashing out, when you get USD for it. Not Tether, but USD, actual cash, is the cash out. Mm-hmm. If the value of that asset you're selling didn't change from the time you bought it, then there's no taxable event. You can take that cash out because you've already recognized the tax when you traded the appreciated asset. In our example, that appreciated asset was Bitcoin. So if Bitcoin went up in value, $100,000, the time you buy that other alt with the Bitcoin is the taxable event. And then if you sell that asset right afterwards, you can take the cash out and there's no additional taxable event so long as that asset you sold for cash didn't go up or down in value.
Okay. Perfect. So questions are starting to slow down. For you guys, I'm gonna look through the questions, make sure we didn't miss any, because there are a couple here, but I want to make sure we didn't miss any. For you guys, tell people how to contact you again, just because, I mean, it seems like they may have some specific questions that are, maybe for their particular things. So if you could help them with that while I look through this.
Sure.
So I believe you have our website listed in the description below.
Mm-hmm.
You can reach out to us. On our website, we have a contact form where you can explain your situation, list your name, your email, and your phone number, and we can schedule a time to sort of sit down and have that complimentary consultation like we mentioned. Also, our email is contact@cryptocpas.com. If you want to shoot us an email, we'll be happy to respond as well.
All right. Perfect. Okay, so someone says Monero is not trackable. Guys, legally, everything reported. Yeah. Someone says Coinbase does reports. They list cryptos sent to an external wallet as a taxable event, even if it's to a cold storage. Any thoughts on that? So sending to a cold storage wallet should be non-taxable event.
Right.
Okay.
I'm not familiar with this report that Coinbase does.
Mm-hmm.
Now, it could be a taxable event if you transfer it out of your Coinbase wallet to go buy a good. Mm-hmm. But no, if you're holding it and then you just want to transfer it to cold storage or hardware wallet, whatever, that's not a taxable event.
Yeah, you should be able to transfer to 1 million wallets and not be taxed on that.
No, not taxable.
Okay.
One thing to keep in mind is, though, those transaction fees when you are sending it to another wallet, if possible, keep track of those, because depending on your situation in 2017, you could potentially use those fees as investment expenses as an itemized deduction. Now, going forward, Andrew, correct me if I'm wrong, I don't believe that will be an itemized deduction in the future with this new tax bill, but for 2017, it's still applicable in years prior as well.
Okay. Someone asks, if you know this one, if Bitcoin debit cards have good reporting, do you recommend your clients to use them for tax reporting? If you know the answer to that one, there are some cards that they can use to spend their cryptos. Is that a good enough record, like a credit card statement of these purchases for tax reporting?
I'd hope so. I don't know what kind of report it would give. I'm hoping in an ideal world it would give like a nice CSV file or API that can seamlessly download these transactions, and it would just be like the same as being on an exchange and saying sale,
Mm-hmm.
or like, selling Bitcoin for an altcoin. I'm hoping it would be like a very similar format. And it would say basically like sold Bitcoin for this dollar amount of this transaction would I guess in my perfect world, that's what it would do. Um, I'm not familiar with any crypto debit cards. I've never used them myself. Um,
I have to believe that it will. BitPay as a payment processor, so receiving Bitcoin as the business, has a nice CSV downloadable file. I have to imagine that they'll have CSV files downloadable, but again, we're not sure.
Okay, cool. So guys, if you have any more general questions, definitely send them. If you have like personal questions, you can reach out to Andrew and Charlie. Their information is down below. You can email them, contact@cryptocpas.com. Let's see. Someone says really good tip on the fees. That's good. Yeah. Let's see. So regarding the fees paid for transferring wallets, if they bought $100 worth of Bitcoin and transferred it to a Ledger Nano wallet, and they paid $20 worth of Bitcoin in fees, which seems a bit high, but can they declare that as a 20% loss?
It would get added to the basis of the eventual sale. So say you transferred all that back into Coinbase and sold it. Mm-hmm. By that point, it would probably be worth about $40 when you transfer it back.
Yeah.
Yeah, it would be a loss. So it would be like even if Bitcoin never changed in value and just the fees caused you to only get $40 back from your $100, it would be a $60 loss. So the best way to do it is to add these transaction fees into the eventual sale of the asset of the coin. Mm-hmm. But sometimes, like as Charlie was mentioning, when it's just a bunch of transactions, and you can't really trace it to a specific sale, right now the itemized deduction is the way to go ahead and take that. And it's more and more difficult to itemize your deductions with these new tax laws. And I think, as Charlie said, I think we need to brush up on our 2018, but I believe they took out investment expense as an itemized deduction, unfortunately. Don't quote me on that. We'll confirm that for 2018.
Cool. All right. So I think the last two questions. So one thing that I recommend a lot on the channel is dollar cost averaging. So buying a fixed dollar amount of cryptocurrencies every week or every month. Someone asked, do you need to keep track of the buy prices over time? And then the follow-up question to that is how to minimize our taxes on crypto in general.
Yeah, I mean the answer is if you're buying something that there's no way to create a report that keeps track of it for you. Like I know Coinbase, you'll probably always have your records of the buy prices. If it's like an ICO you're buying into, then yeah, absolutely keep track of your buy price.
But if they're using ICOs, Coinbase should keep track of it for them.
Right.
Cool.
Coinbase, very well regulated. They'll have your records for you.
Awesome.
Some of these other like decentralized exchanges and especially some of these new ones coming out, I have no idea if they'll keep track of your records for you. So definitely. And when you use Shapeshift, for example, and I know Shapeshift has some. I don't think you can pull any records really. It's pretty important. No. So.
Yeah, you have to keep a detailed record whenever you use Shapeshift, or I believe another one called Changelly, because what will happen is when you enter all of your information in this software, it will start looking and it'll say, oh, you're selling Bitcoin, but we don't see you had this Bitcoin in the first place. Like when did this happen? So it's really important to take note of these sort of trades that you make on Changelly or Shapeshift and write down all the information that you would in any other trade.
Awesome. All right, and then last thing, any quick tips for how people can minimize their taxes aside from getting a good crypto tax expert?
I think the biggest thing is to take advantage of the long-term capital rates. So if you're invested in a coin, in an ICO, and you've been holding it for 11 months, and you really don't need the cash, and you see it on an upward trajectory, hold it for 12 months and get the long-term capital gain sort of tax treatment. Those rates are pretty significant, the difference in those rates, and that can go a long way if we're talking large sums of money.
Yeah, and to go along with that, it's just a matter of being cognizant of your total income as a whole, like even outside of crypto, and knowing kind of knowing what tax bracket you're falling into. If you're having a slow year at work outside of crypto, or if you're having a very high income year, it might make sense to not sell any crypto and to hold off. Because as of now, it'll get added to your marginal rates. So the biggest thing is to be aware of your current tax rates and the marginal effect to your taxes that selling crypto would have. And yeah, that's about it.
Okay, cool. Someone asked for a difference of examples in those rates. Is there somewhere they can look to see those? They could just search it on Google?
Yeah, just 2017 or 2018 income tax brackets.
Okay.
And you'll be able to see the rates to the exact dollar amounts for each bracket, as well as for long-term capital gains, those dollar amounts as well.
Cool. Well, that is it. We spoke crypto, we spoke taxes, we answered questions. Anything else that you guys wanted to mention that you want to make sure everybody else knows?
No, just that we're open. We're looking forward to talking to people about their situations, and we're here to help. And yeah, we kind of know. Well, we want to know how we did. I hope your viewers are finding this to be.
Yo, guys, give us a number 1 if it was useful to you. And also go over to their Facebook page and like it. They say you did great. Number 1. 1. Okay, awesome. Thanks, guys. Awesome stuff. They're reaching out soon. Lots of ones. Okay, awesome. You guys did awesome.
It's good to hear.
Very helpful. Thank you.
Thank you for having us on the show, and thank you all for watching.
Yeah, absolutely. Thank you so much for joining us, guys. If you have not yet, go to their Facebook page, give it a like, reach out to them, contact them. As you can tell, they're crypto tax experts. All this stuff way over my head. That's what they're here for. All right. So cool. Thank you guys for joining us. If you have any more questions, contact at cryptocpas.com. Their website's in the description. Catch you guys later. You two stay on here. We're going to chat for just a sec. But everybody else, peace. Thanks for joining us.
Bye, everyone.